Good afternoon, everyone. My topic for today is about savings, investment, and the market for loanable funds. In this chapter, we also discuss how investors, financial institutions, and markets affect the macroeconomy. When we're finished, you will understand why interest rates rise and fall, and you will also appreciate the role of the loanable funds market in the larger macroeconomy. What is the loanable funds market? Loanable funds market is the market where savers supply funds for loans to investors. So the purpose of loanable funds market is um, to get funds from household savings and foreign firms. And from there, investors such as firms and governments borrow money. So in this graph, savings is channeled into investment in the loanable funds market. In this market, loanable funds are the goods that are bought and sold. The price is an interest rate, and this price, like any other market, determined price is reached through the interaction between supply and demand. Now, savers do not put their money in the loanable funds for nothing. They get interest rates as a return for savings. Interest rates as a saver is the return you get for supplying funds to the market. For example, let's say your parents gave you some cash when you came to college this semester, and after buying textbooks, groceries, and other supplies, you have 1,000 left, in which you have put it in the bank and saved it. So if you save $1,000 for 1 year at an interest rate of 2%, the value of your account will be $1,020 next year, computed as follows. So 2% of your 1,000 is $20. $20 is your return for supplying funds to the market. We now turn to the demand or investor side of the loanable funds market. For this, we shift to the firm's perspective and return to your plan to produce college apparel. Assume that you need 100,000 to start your business. So if you borrow 100,000 for 1 year at an interest rate of 6%, you'll need to repay 106,000 in 1 year. It makes sense to borrow this money only if you expect to earn more than 6% or 6,000 on this investment. If you expect to earn less than this, you are planning to lose money. Okay, so the cost of borrowing is 6% times $100,000. So we get 6,000 as the cost of borrowing. In this graph, it shows the supply as savings and demand as investment. As the interest rates increases, so is the supply for loanable funds increases. More will save because the return is higher. But this is not true for the demand for loanable funds because as the interest rate increases, that means the cost of borrowing increases, the demand also decreases. Okay. How inflation affects interest rates. Inflation is the rate of increase in prices over a given period of time. When making decisions about saving and borrowing, people care about the real interest rate, not the nominal interest rate. So in order to get the real interest rate, we will use Fisher equation. The real interest rate equals nominal interest rate minus inflation rate. Let's take a look at the graph below. Though this is an inverse, we'll just use the inverted formula. Nominal interest rate, real interest rate plus inflation rate. We get this result. Now we will now answer Next, we will now answer the question, what factors shift the supply of loanable funds? Recall that the supply of loanable funds comes from savings. If you have either a saving or a checking account, you're a participant in this market. Increases in income generally produces increases in savings. If income declines, people save less. These changes shift the loanable funds supply curve. As incomes grow, nations save more. Another factor is time preferences. A term time preferences refers to the fact that people prefer to receive goods and services sooner rather than later. Let's take an example are those who go to college. So they have weaker time preferences than those who do not go to college. Next factor is consumption smoothing. Consumption smoothing occurs when people borrow and save in order to smooth consumption over their lifetime. So here is an example of consumption smoothing. An individual borrows in his early life because his income is not enough to cover his expense plus accumulation of properties. In his prime earning years, because his income increases, he starts to pay off debts and starts saving for his future, like retirement. Later in life, at retirement, is the saving. We will now answer what factors shift the demand for loanable funds. First is the productivity of capital. So, to determine whether you should take a loan, recall our rule: a firm should borrow to fund an investment only if the expected return is greater than the interest rate on the loan. If capital is more productive, the demand for loans increases. If capital is less productive, the demand for loan decreases. An example is the internet. Internet provides opportunities and open doors for connectivity across the globe, especially for business. So, the internet also increases the productivity of computers, which are a major capital expense. So, over the past 20 years, an increase in expected returns associated with the internet has made investment in computer equipment more attractive. This means that investment in capital yields greater returns, which in turn increases the demand for loans. Next is the investor confidence. Investor confidence is a measure of what firms expect for future economic activity. Another factors for the shift in the demand for loanable funds is investor confidence. It is a measure of what firms expect for future economic activity. As shown in this graph, so if a firm believes its sales will increase in the future, it invests more today to produce future goods. If instead it believes its future sales will fall, it invests less today. Now, how do we apply the loanable funds? Equilibrium in the loanable funds market occurs as the interest rate where the plans of savers match the plans of investors. That is where quantity supplied equals quantity demanded. Here, the graph shows that equilibrium in the loanable funds market occurs where supply equals demand. At an interest rate of 5% and a quantity of 250 billion, because investment is limited by savings, exactly 250 billion is saved and 250 billion is invested. In conclusion, loanable funds come from households and foreign entities, and in return they get incentives in the form of interest. The higher the interest for savings, the higher is the supply for loanable funds. Investors or firms are those that demands or borrows the loanable funds. A borrowing firm should consider the productivity of its capital. The firm should incur returns more than its borrowing. So, as in the case for the demand of loanable funds, the interest rates are the cost of borrowing. So that would be all for today. Thank you for listening and God bless you.